All right, study group, let's dive in. If there's one topic that is an absolute guarantee on the SAFE exam, it's the Truth in Lending Act. You know it as TILA. I know it can feel like a monster, but trust me, getting this down is critical. So today, we're going to do just that. Break it down, make it stick, and get you ready.
So here's our game plan. First, we're going to get the big picture. The why behind TILA. Then, we'll get into the nitty-gritty of APR and how costs are calculated. After that, it's all about the disclosures, the ads, and some special rules like qualified mortgages, before we land on a topic that trips up a ton of people: high-cost versus high-priced loans.
Okay, let's start at square one. Before you try to memorize a single rule, you've got to understand the whole point of it. Why does TILA even exist?
At its core, TILA is all about one simple idea: clarity for the consumer. It was put in place way back in '68 to make sure lenders couldn't bury the real cost of a loan in a bunch of confusing fine print. So, if you see an exam question asking about TILA's main purpose, look for the answer that talks about promoting the informed use of credit. That's your key word.
Now this right here, this is a classic exam question just waiting to happen. It's really simple when you break it down. Congress makes the law. The Federal Reserve Board, or FRB, writes the actual rules, and they called it Regulation Z. You have to burn that into your brain. TILA is Reg Z. And today, the Consumer Financial Protection Bureau, the CFPB, is the one that actually enforces it all.
And if you're wondering why this matters so much, well, here's your answer. The penalties for messing up TILA are no joke. For 2025, we're looking at over $14,000 for a single first-time slip-up. It just goes to show you how seriously the regulators take protecting consumers under this law. Okay, so if TILA is all about telling the consumer the true cost of the loan, how do we actually measure that cost? Well, that brings us to maybe the most important concept in all of TILA: the annual percentage rate, or APR. It is so much more than just an interest rate, and you can bet the exam is going to test you on that difference.
The whole point of APR is to give a much fuller, more honest picture of what a loan really costs. The best way to think of it is the interest rate plus all those other finance charges, like origination fees and points, all bundled into one number. It shows the borrower the effective rate they're truly paying each year.
All right, listen up. This slide is your new best friend. Seriously, take a picture of it, write it down, whatever you need to do. The exam loves to ask what goes into the APR. A simple way to think about it is, fees the lender charges for the loan, like origination and processing, they're in. Fees for third-party services, like title insurance or an appraisal, they're generally out.
So we know what makes up the cost. But how, and, just as importantly, when, does the borrower actually get to see all this information? That's where TILA's disclosure rules kick in, and this is all about specific forms and very, very strict timelines.
This whole timeline is built around a rule you just have to know, the 3-7-3 rule. Think of it as a countdown. First, you have 3 business days from application to get that loan estimate out. Then, you hit a mandatory waiting period. You can't close for at least 7 business days. And finally, the borrower must get the final closing disclosure at least 3 business days before they sign on the dotted line. 3-7-3. Lock those numbers in.
And here's a quick but super important detail for compliance. Any records related to TILA disclosures have to be kept for 2 years. It's a simple fact, but it's an easy point to grab on the exam.
Now, TILA's reach goes beyond just the loan disclosures. It also dictates how you can even talk about loans in your marketing, and it gives the consumer a powerful out clause after they've signed. Let's dig into advertising and the right of rescission.
Let's kick things off with advertising. The rules here all circle around this one key idea: the triggering term. So, what exactly is that? What does it mean?
Here's the deal. If your ad gets specific and uses a number about the loan, like saying 20% down or only 36 payments, that's a trigger term. And as soon as you say that, you've triggered the requirement to give a whole bunch of other disclosures right there in the ad. And the most important one is the APR.
Next up, the right of rescission. Just think of this as a 3-day cooling-off period. It gives a consumer the power to walk away from the deal, no penalty, no questions asked. But, and this is a big but, it only applies to certain loans on their main home.
So when does that 3-day clock actually start ticking? This is so critical for the exam. The clock doesn't start until the day after the absolute last of these 3 things happens. The note has to be signed, the TILA disclosure has to be delivered, and the borrower needs 2 copies of their rescission notice. If even one of those pieces is missing, that clock hasn't started.
This chart, this lays out a huge distinction for the exam.
The rate of rescission kicks in when a homeowner is borrowing against the equity they already have in their primary home, so think refinances and HELOCs. What it does not apply to is a loan to buy a house in the first place. That is a massive point to remember. No rescission on a purchase.
Okay, let's talk about how TILA has changed with the times. After the 2008 financial crisis, some really big protections were added to the law. This section covers two of the most important ones: the ability to repay rule, or ATR, and this thing called a qualified mortgage, or QM.
The idea here is actually pretty straightforward. The ability to repay rule basically says that lenders have to do their homework to make sure a borrower can actually afford the loan they're getting. And a qualified mortgage, a QM, is like a shortcut to proving you did that. It's a loan that's considered safer, so if you make a QM loan, it's presumed you followed the ATR rule.
So what makes a loan a safe QM? Well, it's mostly defined by what it's not allowed to have. QMs can't have those risky features like interest-only payments, negative amortization, or loan terms over 30 years. And there's a hard cap on the upfront points and fees. They can't be more than 3% of the loan amount.
Okay, team, final section. We're going to nail down two terms that sound almost the same but have totally different rules. This is a spot where a lot of people get tangled up on the exam. High-cost loans under Section 32 and high-price loans under Section 35.
This table is everything you need to keep these two straight. High-cost loans, that's HOPA, have a super high APR trigger, 6.5% over the average rate. Their big rule: the borrower must get counseling. Now, high-priced loans have a much lower trigger, just 1.5% over. And their defining rule is that you must set up an escrow account for at least 5 years. And notice, neither one is allowed to have a prepayment penalty. This slide right here clears up one of the toughest parts of TILA.
All right, we have covered a ton of ground, from the big ideas down to the really specific rules on high-cost loans. The key now isn't just to have this stuff memorized, it's to start spotting it in practice questions. So as you keep studying, start asking yourself, what's the first TILA red flag you're going to look for now? When you can answer that without even thinking, you know you're ready. You got this.